Jane Ong, and welcome to Beat the Street, the show that gives you all the tradable news and data that you need to know ahead of every day's Wall Street Open. Coming up, the dollar edges lower on hopes that the Fed's tightening is near an end. Oil prices also in focus are steady, but tight supply expectations are growing. And US indices continue to power on as data points to a more dovish Fed. Well, good afternoon. Welcome to this brand new edition of Beat the Street, the show that gives you the pre-market every day ahead of the open. Oil prices, I want to show you this because they're seeing upside pressure and high inflation is, of course, still a threat. But if you look at markets in the first half, well, they continue to edge higher. Also showing you gold as well, because that continues to be of interest to our clients because of the growing confidence that the Fed may be at the end of its tightening cycle. This has been underpinning the price of gold here. More on that in a moment. Just showing you a bigger picture view, though, of what we've seen here in the first half, and that is that grind higher. Markets, of course, closed today due to Labor Day, but I'm showing you this just to illustrate this climb despite consumer confidence falling more than expected in August, despite delinquency rates among the credit cards issued by smaller banks at the highest on record, says Apollo Group, and also consumer stress being seen, which is prompting some fund managers to grow more conservative in their outlooks, even as the broad stock market continues to rally. Well, amid all this, and to find out what's in store for equities in September and beyond, here's IG's chief market analyst, Chris Beecham. So where do you think they're going to go in September?
Still higher, we think. September has a bit of a reputation as a tough month. But when you get years like this one, when you have a strong start to the year, and the 8 months so far in the year have been a very solid performance for US equities overall, then that points, unsurprisingly perhaps, towards more gains in September and indeed beyond. So I think that September's reputation as a tough month for stocks is somewhat perhaps unfairly merited. But certainly 2023 has been the year of surprises. Everyone thought there'd be a recession this year, that markets would keep falling. Of course, they rallied, as you see, from October and didn't look back. And fundamentally, although perhaps there are concerns now about where oil prices go from here, we still think that there won't be a recession this year, and that gives more room, I think, for stocks to advance in September and beyond. How
about tech? We saw this big advance earlier on in the year. A lot of it, many fund managers have said, based on hot air, not everyone knows where these AI tech-related revenue streams are going to come from. Where do you think that's headed in the second half?
Yeah, that's the big risk. And the Nasdaq was such a big gainer for the first 8 months of the year. Really, it was all about tech. It was AI. Earnings expectations were so low heading into this year that really they couldn't get any worse. And a lot of that has now been priced in, certainly. But as NVIDIA showed, actually, they are starting to deliver on those earnings promises. I think we may get a bit more cautious as we head into the next earnings season, but certainly there could be more to come, really, particularly if, and this is still the big if, the economy can avoid a recession next year as well. There's no law that says there has to be one, and if the economy continues to grow in the US and globally, if we don't get a kind of nasty upset in the first half, there is room to run for stocks.
And just very quickly, Chris, if you had to pick one, what would the biggest threat be? I mean, we've got a lot of central bank action coming up. We've got the jobs number. We've got China still faltering there in terms of its post-lockdown recovery. What would be the one key threat if you had to choose one for the second half?
The Fed goes back to hiking, I think, because oil is now, as we'll see later, it's moved on. It's moved to its highest level in a year. And if the Fed has to respond to a resurgence in CPI, that will upset a lot of people's expectations for the rest of the year.
Interesting stuff. Thank you so much, Chris. And we'll check in with Chris again later on in the week. Investors also hunkering down and rejigging their portfolios ahead of the next earnings season. Stock investors have been satisfied by middling US corporate results so far this year, but they might not be so easy to please for the rest of 2023. Plus, there's also the issue of expectations for the coming earnings season being too high, says Liberums' Joachim Clement.
We think that the rebound in the ISM and other PMI indicators points towards a reacceleration of the US economy, and with it, better earnings outlook in the second half of this year. Especially once the Fed has made it absolutely clear that they are not going to hike interest rates anymore, we think that should also lead to a re-rating with rising PE ratios across the board. But in particular, for more growth-oriented stocks, tech sector is what we like in particular.
Now, as we mentioned earlier, a couple of central banks will draw attention this week. On Tuesday, the Reserve Bank of Australia is due to decide on its rates. Its official cash rate, almost unanimously expected to remain at 4.1%. On Wednesday, the Bank of Canada, too, economists think that Tiff Macklem will keep the BOC overnight rate at 5%. Now, the latest Reuters poll on RBA rates show that almost all of the economists agree on unchanged rates as inflation rates show signs of easing. The majority of them expect a final rate hike next quarter, and the Aussie dollar still trades near the 2023 lows against the US dollar. No change expected also in Canada. Of course, on Friday, the Canadian economy missed expectations. The GDP growth rate was flat quarter on quarter. Economists had expected a 0.3% rise. The Canadian dollar trading near three-month lows against the US dollar. Here, with his expectation for what we might hear from the BOC, is Zain from Daily FX, part of IG Group.
The Bank of Canada interest rate decision in the week ahead promises to be an intriguing one. Now, obviously, the Bank of Canada has hiked rates quite aggressively during the course of 2023 thus far, being the first central bank, obviously, to start on the tightening cycle from the major central banks. Now, obviously, the most recent rate hike came in July, on July the 12th, accompanied by, obviously, a renewed forecast for the rest of 2023. Now, obviously, since then also, we have seen a really mixed bag in terms of data, with inflation, showing signs of reacceleration in July. That was also coupled with a slight increase in wage growth as well. Now, this year also, we did see some pressure on household income as well, where obviously householders are struggling at the moment with the high interest rate environment there, and household debt seems to be a real problem there for the Bank of Canada to consider as well. Now, given all of these factors, I do still think that we will get a pause from the Bank of Canada at the upcoming meeting. I think a lot of this will be down to the fact that the central bank will be looking to see more data points before making their next move. Obviously, I think one more inflation print especially will be really key for the Bank of Canada moving forward, as they were within their range or targeted range of inflation before the July print came out, which showed signs, as I mentioned, of reacceleration. But I do think that they will wait to see if that was just a once-off rising inflation or whether this is a permanent increase in inflation moving forward, and then obviously that will force the bank to act. As I said, I do expect the bank to hold rates steady this week, and I do think that looking forward, they will wait for the next inflation print before making their next move.
Zain there from Daily FX ahead of the Bank of Canada's rate decision. Now, oil prices steady at the moment, with investors hoping that the still tight supply picture will remain in play. Both Brent and WTI ending last week at their highest in more than a year, more than half a year actually, after two previous weeks of losses. Let me just show you Brent as well. That's Brent there, and US crude rather. As you can see there, it's back up at the 8512 level, actually above that 8550 now. These two instruments benefiting from the weakness of the US dollar, and were also supported by economic support measures unveiled by Chinese authorities. Of course, underlying all this, OPEC Plus's supply cuts also on the cards after Russian Deputy Prime Minister said last week some countries in the organization have agreed to pursue production cuts. But last Friday, the total rig count also fell by one, taking the total rig count down to 631. The number of active oil rigs remained at 512. Now, staying with oil, Chevron and unions have begun mediation talks to avert an Australia LNG strike. Now, should talks fail, a strike will go ahead on Thursday and could hit more than 5% of global LNG production capacity. The union group has also said that the stoppages could cost Chevron billions of dollars. And finally, Apple, Nvidia, Alphabet, AMD, and other big names and customers of ARM Holdings have agreed to invest in the chip designer's IPO in that price range, reports Reuters. SoftBank will now hope that once trading, ARM shares will attract other investors. SoftBank acquired the 25% stake in the company it did not already own at a valuation of $64 billion. On Friday, the Wall Street Journal reported that SoftBank is targeting a valuation between $50 billion and $55 billion for the semiconductor and software designer, pricing shares between $47 and $51. And just before we go, that growing confidence that the Fed may be at the end of its tightening cycle, as I mentioned earlier, helping to underpin gold. Let's just take a look at gold for you, because this is a very interesting graph here for you. As you can see there, it has been steadily climbing since around November 3rd, hitting that high point there at around May 2074. And at the moment, if you look at this chart here, it's slowly bouncing off that green line there. And if it continues to see that momentum, we could see it breaching the 1954 level. And after that, perhaps it could go towards 2000 as well. The jump in the US unemployment rate and moderate wage growth suggesting that labor market conditions were easing. Also looking at gold ahead of course, the jobs figures. And of course, trading is quite thin at the moment because markets are closed for the Labor Day holiday. Now, before we go, just a reminder that we have this show every day at 1:30 London time. We will continue to give you all the market-moving stories throughout the day, though, if you log into IG.com. That's it for now for this edition of Beat the Street, the show that follows all the trading action, helping you position yourself ahead of the market action. For more trading insight, follow me on @IG.com and @Angeline Ong on Twitter. This is IGTV.